Hi everyone, welcome to our class. Today we're going to be talking about first-time home buying. I'm Tammy Irby with Samson Properties, and I am part of the Live the Easy Life team here at Samson Properties. We are a family team of realtors. It's myself, my daughter Christina, my husband Richard, and my daughter Andrea. We have over 31 years experience successfully selling homes in Northern Virginia for our buyers and our sellers. So let's get started with our class. I found as an agent that my buyers could go one place and get information on what was for sale, another place to find out about loans, but nobody ever really took and put it together for them in a comprehensive format. So we used to do these classes in person once a month for about 10 years in our office, but now with technology we can bring them to you in your own home, and you can just go grab a drink and put your feet up and settle in, because our class is going to cover a lot of information, and feel free to come back and take the class anytime you'd like. So this is what we're going to cover today. We're going to calculate your housing payment. We're going to assume you don't know anything about buying a house or mortgages, and so we're going to do a sample housing payment for you. We are going to talk about why own a home, renting versus buying after 5 years. We're going to talk about all the different financing that's available to you, different types of loans, cover your closing cost, how much cash you need for your closing cost at settlement, questions on closing costs. We're going to actually do a breakdown of closing cost on our sample home today. Then we're going to look at qualifying. I'm going to tell you how the lender looks at you for qualifying with ratios, your credit scores, what they look for, your documentation, what not to do during the loan process. Then we're going to talk about buyer representation, benefits of being represented, how your agent is actually paid, and then questions to ask when you're choosing your agent. From there, we're going to get into what I call the 7-step program of buying a home, all the way from getting educated, asking questions, your initial appointment with your realtor, viewing and selecting your home, the sales contract. We're going to cover an actual sales contract, and the negotiations, finalizing your loan, contingencies and inspections that you should do on a home, and then the walkthrough and the settlement, the final settlement of your home. So breaking down your housing payment. Your monthly housing payment is commonly referred to as your PITI. P is the principal that you pay each month with your payment to pay your loan down, the balance of your loan down. I is the interest that goes to your lender. T is for your real estate taxes that get paid to the county. Your taxes in Fairfax County are paid twice a year. Your lender is going to pay those for you. But how they're going to do that is they're going to collect 1/12 of your real estate taxes each month with your payment, and then they're going to pay the taxes when they're due in the county. Then you have your fire and your hazard insurance. That protects your property against casualty. You pay 1 year up front before you go to settlement or at settlement, and your lender then collects 1/12 of that amount for the premium each month with your payment, and then they pay the policy when it's time to renew it next year. You shop around for that just like you do for your automobile insurance, and use whoever you choose. Now, your payment may also include PMI or private mortgage insurance on conventional loans, or MIP, mortgage insurance premium, on FHA loans. This insurance covers the lender in case you default on the loan payment. It's required on most conventional and FHA loans with less than 20% down. It's not required on VA loans. They have a funding fee instead, and it is 2% of the loan amount for first-time users, and most of the time the veterans can finance that onto their loan amount. There are some conventional loan programs that will allow you to get out of the PMI, so talk to your lender about that. So in our example today, we are going to assume you're going to buy a townhouse valued at $400,000. That's pretty normal first-time buyer price range in Northern Virginia, if you can believe that. And we are going to use this same townhouse for renting versus buying and our closing cost example, as well as the monthly payment. So in our example, the buyer is going to use FHA financing. It is a fixed year 30-year loan at 4.25% for our example. Minimum down payment 3.5%. FHA, remember I told you, has two types of mortgage insurance. They have an upfront mortgage insurance of 1.75% of the loan amount, or $6,755. Now, in our example, we're going to finance that. So the monthly payment on this loan is $2,622 plus any condominium or HOA fees that are assessed to the property. Those get paid separately each month. So we have a sales price of $400,000, 3.5% down, or $14,000. Loan amount with mortgage insurance premium finance, $392,755. So our principal and interest payment on this loan is $1,932 plus $273 for your mortgage insurance premium, $350 a month for your real estate taxes, $67 fire and hazard insurance, for a total monthly payment of $2,622. Now, let's look at renting that same townhouse. Why own a home to begin with? One, stability. You don't have to move as often and your payment is fixed. You have pride of ownership. You can make it your own. You can paint whatever color you choose without having to ask permission. You're going to build equity over time when you own. And your overall cost in the long run is less for buying. So after that, townhouse would rent for about $2,000 a month. So after 2 years, you would have paid out $48,000 in rent. After 5 years, $120,000 in rent. And after 10 years, $240,000 in rent. And probably a lot more than that, because most of the time your landlord is not going to keep your rent the same after a year, more or less 10 years. And rents in our area tend to go up about 3% a year on average. So renting versus buying this townhouse after 5 years. I don't have a crystal ball, but if I did, in our example, we are going to assume that you have about a 3% appreciation rate on that townhouse. And then we're also going to use a 5% appreciation in case the appreciation is a little bit more. So after 5 years owning, with a 3% appreciation, the townhome would be worth $463,708. After 5 years, it would be worth $535,289. If you would have rented at $2,000 a month, you would have paid out $120,000 after 5 years. Of course, your payment is more when you buy, so you would have paid out $157,300. But then less your equity build up. With renting, you would have zero. So after 5 years, your cost would have been $120,000. After your equity build up, it would be $93,612 if you had a 3% appreciation rate. And if you had a 5% appreciation rate, that same townhouse would have cost you $22,031. That's a great reason to buy a house. In addition to this, you may have some tax benefits when you buy. The tax laws have changed, so you want to check with your accountant. You might be able to deduct your interest and your real estate taxes that you pay on the property. So types of loans. Loan amounts are either conforming or non-conforming, depending on the amount of the loan. Non-conforming loan rates are usually higher because the loan amounts are higher and the risk for the lender is greater, so the rates tend to be higher. You really have two types of loans. You have conventional loans. These loans are backed by Fannie Mae or Freddie Mac. The lenders use the guidelines for Fannie Mae and Freddie Mac lending set forth by these agencies, and they will buy the loans from the lenders if they abide by these guidelines. Then you have government loans. They're funded and or insured by the federal government. You have an FHA loan, a VA loan, and a VHDA loan. And we're going to get into all of these different loan types in just a second. Then we have owner financing. This is more rare. We usually don't see too much owner financing out there, but occasionally you run into it. So conventional loans. Conventional loans have a 3 to 5% minimum down payment. PMI is required with less than 20% down unless you do something with the lender to get rid of the PMI, and you could talk to the lenders about that. Your down payment and your credit score will affect the interest rate you get. The better your score and the bigger your down payment, the lower your interest rate's going to be. 100% financing is available if you qualify. FHA loans. These loans are insured by the Federal Housing Administration. They have a lower down payment, 3.5% down payment is required. However, 100% and 102% financing is available for first-time buyers that qualify with the VHDA guidelines, which we'll talk about in a minute. Gift funds may be used for a down payment. Easier credit guidelines. If you have a lower credit score, sometimes buyers will use the FHA loan because of that. They are perfect for borrowers who have little or no credit because they can use alternate means of verifying credit. The property must be in good condition. Then we have VA loans, which are guaranteed, I should say, through the Veterans Administration. They are for veterans, active duties, or members of the reserves and the National Guard if they meet certain qualifying guidelines. The loan limit is $679,650 in the Northern Virginia area, and you can go up to $1 million with a down payment. Easier qualifying, easier credit guidelines on VA loans. Property must be in good condition. And again, they have the funding fee that can be financed or paid up front. And for some disabled veterans, the funding fee may be waived. There's a chart below that shows you some of the different things. And if you're using your VA for the second time, the funding fee is a bit higher. VHDA loans. These are through the Virginia Housing Development Authority. Virginia has a program where they go out and they sell bonds. Then they use that money to fund the loans for people who have not owned a home in Virginia in the last 3 years. Low to no down payments if combined with a second loan. They also have grant money or free money that you can use for part of your down payment if you fall within the qualifying guidelines. And these are income guidelines, basically based on the size of your family. They can sometimes be below market rate. If the bonds are sold and they have this money left, the rate could be lower if the rates have gone up since they bought the bonds. The rate is the same rate with all lenders also. That's something to know. So within these programs, we have 3 different types of loans. We have fixed, adjustable, and buy-down loans. So fixed payments are just that. The interest rate's never going to change over the term of the loan. You can get a 15, a 20, a 30, or a 40-year loan term, but the 30 is the most common. Buy-downs. Buy-downs are a variation of a fixed or an adjustable rate loan. Payments are set in advance and adjust at preset intervals and rates. So you usually qualify at the start rate, except on VA you qualify at the second year rate. So people use buy downs to usually help them qualify, or maybe maybe there's a couple and one of them is in grad school and the other's working, and they know that once that person graduates and gets a job, they're going to have a bigger income, so they need the lower payment now. They might consider a buy down. The note rate is usually about 0.5% higher than had you gone with a fixed rate to start with. The note rate is the end rate for the final payment. Then we have adjustable rate mortgages, or ARMs. There are 1 month, 6 month, 1 year, 3, 5, 7, 10-year ARMs. There are loans that are fixed for 5 years and then they adjust once a year. Fixed for 5 and they have one-time adjustment and they're fixed for the next 25 years, and the same for the 7/1 and the 7/23. The loan interest rate is fixed for a shorter term and then it starts to adjust. ARMs have cap protections for the adjustment and the lifetime cap of what it can never go over. They are all tied to an index, and that indexed, like the 1-year treasury, is used to adjust the rate when it's time to adjust. Then there's a margin, and that's added to the index to get the new rate at the adjustment time. It can be combined with buy downs, believe it or not, to get even lower start rates. The shorter the term, the better the interest rate. The most popular loans right now, though, are the fixed rate loans because the interest rates are so low. So now that you know a little bit about your about loans, let's start to talk about the total funds that are needed to buy your home. Well, we have your down payment plus your closing cost equals your total funds needed to purchase your home. Where can you get your funds for your down payment and your closing cost? Well, the best way is to get it from your personal savings. Some loan programs allow you to get a gift from a relative. You could borrow from your own 401k plan. I think you can avoid some penalties if you're pulling money out to buy your first home or to buy a home. You can cash in an IRA account. You can get a grant through the VHDA program if you qualify. Lender could subsidize part of your closing cost. They charge you a little bit higher rate, and then they'll help you subsidize some of your closing costs for that. It's not free. And then possibly the seller could assist with helping pay some of your closing cost. So most common questions that I get on closing cost are, can the seller pay my closing cost? Well, the answer is the seller can pay part or all of your closing cost. However, there are limits, and they depend on the amount of your down payment and the type of loan you're getting. There are guidelines in all the different categories on how much they can assist. And note this, that in a seller's market, it's harder to get help from the seller with your closing cost. Second most common question is, what are points? Points are simply prepaid interest. The lower the rate, the higher the points or the cost to obtain that rate. You can buy down your interest rate by paying more points up front. Is it worth it to pay points? Well, that depends on how long you're going to stay in the property. I'm going to give you an example of points. So at 4 3/4, there are no loan discount points and no loan origination fees. Both of these are considered points. The lenders just try to confuse you, but they're both points. If you want to buy that rate down to 4.5, you're going to have about a 1/4% loan discount and 1% loan origination fee. At 4 1/4, you're going to have about 1.5 loan discount points and 1 loan origination fee. So on a loan of $386,000, 1 1/4 points is 1.25% of the loan amount, or $4,825. On a loan of $386,000, 2.5 points is going to equal $9,625. So ask yourself, how long do I think I'm going to stay in that property? And that will tell you whether you're going to be able to make up that additional cost in points while you're in the property. If you're not going to stay there very long, it may not be worth it to buy your rate down with points. Now we're going to go over an estimate of closing cost on this sample townhouse. We have a sales price of $400,000, again an FHA fixed rate loan at 4 1/4%, a down payment of $14,000, and loan amount with mortgage insurance $392,755. Our total monthly payment was $2,622. So with closing cost, we're going to do the breakdown here. We don't have any points on this loan, no loan origination, no loan discount fees. We have a $475 fee for an appraisal. If your contract is contingent on financing, your lender requires you to pay for an appraisal. It's an independent third party that you don't choose, and the lender doesn't choose, and the seller doesn't choose. They order it through what we call an appraisal management company, who assigns an appraiser to go out and make sure that the property is going to appraise for the sales price. If it does not, and the seller may reduce the price to the appraised value. If they don't, unless you want to make up the difference, the lender probably wouldn't give you the loan. So if that happens, you can get out of the contract if the seller won't reduce the price to the appraised value. The credit report, that's about $25. Sometimes it's $60 roughly. Miscellaneous lender fees would be just document fees, things like that from the lender. About $1,450 is about average. Attorney fees, that's for the attorneys to conduct the settlement. That's $485. You have to record your mortgage and the new deed in the county records. That's $105. Survey is optional usually. If you choose to have a survey done on the property, it's about $275. Of course, on a bigger parcel, it's going to be more. No tax service fee. Let's see, city and county tax stamps based on your sales price, that's $661. The state will not be outdone. They have a tax on the sale of $1,982. Then we have what we call lender's title insurance. The title company is going to go do a title search on the property, and the lender requires you to cover them with title insurance, your loan amount with title insurance, to make sure that if something wasn't discovered during that title search comes back later and somebody makes a claim on the property, they're going to get coverage. And that is $1,093. You have the option to cover yourself with an owner's title insurance policy, which I highly recommend, because if somebody successfully makes a claim against the title and takes the property away, you could lose your equity. So that's $1,093. And I think it does have a clause in it where it allows it to go up for appreciation up to about 150% of the original value. So even if you don't put a lot down, if you're in the property a while, you could have some equity that you don't want to lose if something happens to the title. Then you have flood certification of $14. FEMA requires the government or the lenders to have them check the flood maps and make sure the property you're buying is not in a flood zone. If it is, they have to buy flood insurance, and that's $14. Home inspection, of course, is optional, but I recommend it, so I went ahead and put a $400 fee in there for a home inspection. So the closing cost on this part of the breakdown add up to $8,172. Then we have what we call prepaid closing cost, which are basically your money set aside to pay something later. When you go to settlement on a house, you've probably heard your friends talk about this. Oh, settle at the end of the month, it's cheaper. Well, it's not really cheaper, it just depends on when you pay the interest. So let's say you go to settlement on the 25th of May. Your first mortgage payment is not going to be due June 1st. It's going to be due July 1st. So the payment that you pay July 1st is going to include the interest for June. So when you go to settlement on the 25th of May, because you're not going to make a payment on June 1st, you have to make up the difference between the 25th of May and the 1st of June. So in our example here, we use 5 days prepaid interest, or $225. Your first year hazard policy, remember I told you shop around, you use who you want for your fire and your hazard insurance, and you pay 1 year up front before at settlement. That's $804. And then because you're not going to be making a payment for a little over a month, your lender is going to pad your escrow accounts a little bit so that they're not short when it comes time to pay your insurance and your taxes. They're going to put a couple months of your hazard insurance aside, or $134, 3 months of your taxes aside, or $1,050. Once you sell your property, if you have any monies left in these escrow accounts, you'll get that money back. But the government also regulates how much of a pad your lender can keep in these escrow accounts. So these prepaid items come up to $2,213. So prepaids are basically your money set aside to pay something at a later date. So in summary, you would need your down payment, the closing cost, and your prepaid closing cost. So your total cost would be $24,386. Now, the total cash of settlement that you're going to need will be less any amount that the seller contributes towards your closing costs in the contract, any items that you have paid prior to the settlement date. Now, these things would be your earnest money deposit, which we'll talk about in a little bit, your credit report, your appraisal, home inspection, your first your homeowner's insurance policy if you pay that prior to the settlement date. And in addition to these closing costs, your lender, depending on the loan program and your down payment, may require you to have some cash reserves after settlement. Usually they could be in the form of your 401k. They just don't want you going down to zero. So now I'm not going to go over the whole thing, but I want you to see that there is an alternative. Remember we talked about VHDA 100% financing. This is the VHDA FHA Plus program, and this has a little bit higher interest rate on it of 4.875%, but it allows you to have a second trust for that down payment, so that it is basically 100% financing. So in this example, the payment, instead of being $26.22, the payment would be $28.42 because you're financing the whole thing and your rate is slightly higher. But if you look over, because you don't have a down payment, your total cost to get in this property is $10,391. And then in addition to that, if your seller were to help with closing costs, you could pretty much get in for nothing. So now we're going to talk about ratios, qualifying ratios. This is how the lender qualifies you. None of these ratios are set in stone, and they may stretch them according to your individual circumstances. Of course, if your credit is better, they might stretch your ratios a little bit more than for a buyer who has poorer credit. Each of the different types of loans qualify you differently with different ratios. So conventional loans have a front ratio, which is your gross monthly income times 28% equals your maximum housing payment. Then they have a back ratio, which is your gross monthly income times 36% equals your max housing payment plus your monthly debt. Then FHA is a little bit more lenient. They have a front ratio of 29% and a back ratio of 41%. VA has one ratio, 41% equals your max housing payment and your monthly debt. Now we're going to take a sample couple and we're going to qualify them for this townhouse. So in our example, this couple has a yearly pre-tax income of $95,000. So we're going to divide it by 12 to come up with their monthly income. Their monthly income before taxes is $7,916. They have debts. They have a car loan of $425, a Visa minimum payment of $80, and student loan payments of $200. So their total monthly debt is $700. So using the FHA guidelines, you cannot exceed a monthly housing ratio of 35%. So monthly income of $7,916 times 35% equals $2,770. Now you have to fall within the guidelines of both the front ratio and the back ratio. So the monthly debt ratio maximum is 43%. So we take their monthly income times 43%, and that says their monthly debt and housing payment cannot exceed 43% of their income, or $3,438. So in conclusion, you take the $3,438 minus their $700 monthly debt, and what's left over is what they can afford for housing payment, or $2,738. So they would qualify for our sample housing payment on the $400,000 townhome that has a payment of $2,622. Now, remember, you have to qualify for your housing payment plus any condo fees or HOA dues. So if that townhouse had a monthly HOA fee of $70, they still would qualify because they can have a max housing payment plus housing payment of $2,738. So credit scores range. So a credit score is based on data available in the borrower's credit report. It's proven to be a very good predictor of whether or not a borrower can repay their loan. It measures the relative risk potential to the lender or the investor. And there are 3 credit bureaus which they pull the credit report from, and those are Equifax, TransUnion, and Experian. The middle score from the 3 bureaus is used, and the lowest middle score is used when there are multiple buyers. Now, the credit report that you pull as a consumer is different than what the lenders use. They use a tri-merge report for mortgages, and the scores, when they're looking at credit, if you are a 760 or above, you're considered to have A credit. If it's 720 to 760, you're a B. 680 to 720 is a C. 640 to 680 is a D. And no credit history. Remember we talked about FHA? FHA will use alternate sources of credit if you don't have a credit history. So what do lenders look for? Well, they look at your ability and your willingness to pay. So your ability is your employment and your income, your employment history, your income, and your current debts. Your willingness is your credit score and your credit history. So they look at your credit score and your credit history. Documents your lender needs. They're going to need your most recent pay stubs. They're going to need 2 months of your bank statements, all the pages, your last year W-2s, copy of your tax returns. They're also going to pull copies of your transcripts from your tax returns to make sure the information matches, your most recent retirement statements, and your landlord information so that they can verify your past landlord, that you pay on time and whatnot. So caution, what not to do during the loan process. Once you're in the home buying process, don't compromise your credit. Don't buy a car, don't buy any new furniture, open or close a credit card account, don't change your job without consulting with your lender, and of course don't quit your job. Now, one thing that does happen is your lender is going to go through your bank statements line by line, and they're going to ask you lots and lots of questions about the different things that are on there. What they're trying to do is make sure that they have all your debts covered, that there's nothing that you're not disclosing that you're actually paying. Now that we've talked about loans, now we're going to talk about the different types of representation that you can obtain when you're in the process of buying a home. So there is what we call seller's agency, where everybody represents the seller. There is buyer agency, where the agent in the transaction on your side can represent you, the buyer, which is how most buyers work when they buy a home these days. Then there is sub-agency, which both agents represent the seller. They are just a sub-agent of the seller if you haven't hired them to represent you. Then we have what we call disclosed dual agency, and that's when the same agent represents both the buyer and the seller. My team doesn't practice dual agency. We have designated agents, which is a form of dual agency, but it's okay. In this case, the listing agent and the selling agent work for the same company. One of the agents is designated as the seller's agent, the other agent is representing the buyer in the transaction, and the broker becomes the dual agent. So that's okay. So what are the benefits of being represented by an agent? Well, first, we're going to assist you in determining what types of properties are available in your price range and help you locate properties that best fit your wants and your needs. Help you identify any issues with the property, to help you make an informed decision prior to making an offer on the property, and help you determine the fair market price of the home before you make your offer to purchase it. Advise you on how to best structure an appropriate offer to purchase the selected property and present the offer to the seller's agent on your behalf. Help with negotiating the offer with your best interest in mind. And you get an opinion from an expert in the field who's not emotionally involved in the transaction. And we fully represent you throughout the real estate process and keep your confidentialities. These are all benefits when you're represented by an agent. So how does your agent get paid? This is a big question people have. They want representation, but they don't necessarily want, or they can't afford to pay for representation. So some important things for you to know. One, we only get paid a commission when we help you get to settlement on your new home. And when a property is listed in the MLS, that's the Realtor's database of available homes, the seller's listing agent makes an offer of compensation to all the other agents out there to come and help find a buyer for this home. And that's a percentage of the price, which is listed right in the MLS, and we can show you in the MLS listings where they offer to pay us, so you'd never have to worry that you have to pay your agent to represent you. In addition, when you're happy with our service, you're going to refer your friends to us. You're going to come back and buy your next house from us. Our goal is to be your agent for life. So, questions to ask when you're choosing a realtor. How long have you been in the business? You want somebody that's got some experience. Are you a full-time realtor, or is this your part-time job on the weekends? What extra education do you have? Our industry allows us to get designations. We belong to different clubs based on our selling volume and stuff like that. You want an experienced agent who does business currently. You want them to represent you exclusively, in my opinion. What sources do you use to find homes? Right now, a lot of agents just use the MLS to find homes, and in this market with limited inventory, you want somebody to use alternate ways to find your homes. We have a list of 18 ways we go about looking for homes, not just the MLS. How are you going to keep me informed about the progress as we go along? What's your preferred method of communication? We're going to talk about that with you. Can you provide me references? Absolutely. You always want to have references. Most importantly, when you're choosing your agent, though, is that you choose somebody that you're comfortable with and you trust, because if you don't, you're not going to come to a good conclusion. So either way. So that I think is the most important thing. So now we're going to talk about the 7-step program that we talked about before. It's time to get out there and look for a house. So the first step is to get educated and ask questions. So some common questions when starting to look for a home are, how far ahead of when I want to buy should I start to look? Well, typically from the time that we meet and we start looking at homes until you go to settlement, it's usually about 30 to 90 days. Usually takes us about 30 days to find something, unless we find something sooner, and then from contract to settlement, it's usually 30 to 60 days, depending on when everybody can move. When should I hire an agent to represent me? As soon as you start to look. It makes the process a lot easier if we're in there helping you. What can you do now, but what can you do if you want to buy now, but your lease isn't up for a while? I get this question a lot. Most leases have a lease break clause and maybe a lease break fee, and sometimes we can help you negotiate that with your landlord and or help them get it rented so that they might not charge you a fee. What about foreclosures and short sales? We help with foreclosures and short sales. You just don't want to limit those to the only types of homes that you look at. And you have to be prepared to do a little bit of work sometimes if you look at foreclosures. Do I need an agent if I want to buy a new home? You bet you do. The person sitting behind that desk represents the builder and the builder's best interest. You want somebody representing you. And don't think that you're going to get a lower price if you don't have an agent with you. That's not the case. They want us to bring buyers to their homes, so they just don't practice that. And what about for sale by owners? Well, if we see a for sale by owner, we'll absolutely stop, knock on the door, see if they're willing to cooperate with an agent. Most of the time they will. They're just trying to save some money. And at that point, they're usually happy to have somebody come in and help out and do it for them. Step number 2, get your loan pre-approval before you look at homes. So you want to contact your lender to get your loan pre-approval started. They'll have you fill out their online application and pull your credit report. They'll review your available cash to close, your down payment assistance, and your closing cost options. They'll match you with the best available loan programs for you and tell you how much you qualify for. Provide a cost estimate of your down payment and your closing costs that we went over before. and then they're going to provide you with a pre-approval letter. This is really important to do. It's a very quick process. It can take a day. You go online, you fill it out, they'll pull your credit, and within a day, they'll let you know what you're qualified for and run your credit and do a pre-approval for you. When you go out to look at property, your sellers will not even consider your offer if you don't have a pre-approval letter. And the best pre-approval letter is the ones that your income has already been verified and your down payment has already been verified, as well as your credit being pulled. When you're competing on homes, that's really important. So once your pre-approval is obtained, now you're ready to start your home search. So the rest of step 2 is your initial appointment with your realtor. At that appointment, before that appointment, I ask my buyers to make a list of your wants and your needs in a home. You're going to meet with us for an initial consultation to discuss your home search and make a game plan to help you find the right home. Talk about your time frames, your commutes, things like that. Be picky, but don't be unrealistic. Keep an open mind. Maybe you had one style in mind, but maybe there's not much inventory, so you need to be open to other styles. So we'll talk a little bit about that. At that appointment is when you're going to sign your paperwork to hire the agent to represent you. Just like a seller, when they put their home on the market, they hire an agent with a listing agreement. You hire an agent to represent you with a buyer agency agreement. And in that agreement, they agree to represent you, and you agree to work exclusively with that agent. We're going to conduct an initial search of homes available that meet your needs. We're going to use the MLS database of all available homes, as well as about 18 other sources that we use to help our buyers find homes. We will set you up on an automatic search. We're going to print out your initial search or email it to you so that you can have all the pictures and everything. And then set you up on an automatic search to make sure that you don't miss any homes as they hit the market. Very, very competitive market right now. You want to know as soon as something comes on the market, because it's very likely that it will sell very quickly and you don't want to miss anything. Step number 3 is the viewing and the selecting of your home. So here's some helpful tips that we put together when searching for a home. Do your homework before you start looking. Decide what you want and what's most important to you. Don't ask too many people for their opinion. It's going to drive you crazy. Select 1 or 2 people to turn to if you feel like you need a second opinion. I'll tell you, they got your best interest at heart, but they have a very limited scope. Maybe they've bought 1 or 2 homes before, and they really, there's different reasons why things could have happened that they might not have understood. So just rely on a couple good people that you feel confident with. Think long term. Are you looking for a starter house, or do you hope to stay in the home longer? It might be worth it to stretch your budget a little so you don't have to move soon if you're thinking of expanding your family soon. All homes need maintenance after you own them, but older homes will need a little bit more care up front. Remember to set aside money every month for repairs and maintenance. I recommend to my buyers that they start a slush fund of $100 to $200 a month and keep that money aside in case something comes up. That way you're not going to be surprised, and you're going to have the money set aside to make those repairs. And if you don't, then maybe you can do some projects. Tips for buying in today's hot sellers market. Well, right now there's limited inventory and high demand, making it a seller. That's what makes it a seller's market, supply and demand. Be ready to make a decision quickly. Get yourself fully pre-approved for a mortgage. Like I said, make sure that they check your credit. You give them information on where your funds are coming from, and they can verify that, and make sure that they verify your employment. Decide in advance your must-haves and your like-to-haves. You might have to compromise, like we said earlier, in the current market. Keep contingencies to a minimum. Don't get caught in the buying frenzy. Just because there's competition doesn't mean you should overpay the market value for the home. Don't neglect inspections that help ensure that your house is sound. A lot of buyers now are waiving inspections. Maybe you don't waive the inspection, maybe you do an inspection for information purposes only, You're not allowed to ask for repairs, but you can get out if you don't like the results. That's one way to get around that. Remember that getting a good deal in today's market might simply mean getting the bid, winning the bid on the home that you want. Hire an experienced agent that knows how to advise you properly to get your offer accepted in a multiple offer situation. That's where our experience really, really comes in. So, should I buy a foreclosure? Well, the inventory of foreclosed homes has gone down in recent years as the market has improved. So be cautious of condition. The homes are usually sold in as-is condition, and they might need work. They might not, but most of the time they need a little bit of work. Ensure that you can obtain clear title to the property. Be prepared for a multiple bid situation when the property is competitively priced. And that is the case even with foreclosures. A lot of times they'll put it on the market at a lower price trying to get it bid up. It's really impossible for somebody to underprice a house, because if they do, there'll be multiple bids and the market will determine the value. You will be asked in multiple bid situations for your highest and best bid. They probably won't tell us what the other bids are. They'll just say, all right, give us your best bid. No escalation clauses, which is something else that we could talk about at another time. It's part of a multiple bid situation where you escalate the price if they have a better bid. But on foreclosed properties, they usually just ask for highest and best, and you don't know what the other offers are. Short sales foreclosures. What is a short sale? A short sale is when the loan is larger than the current value of the home. That means they owe the lender more than what they could sell the property for. There aren't that many of those around these days because the economy has improved. You must get the lien holder or the loan holder to approve, in addition to the seller approving it, the sale, because they're the ones who are going to be taking a short. Now, the biggest thing with the short sale that you need to know is that it can take some time to get the lender to approve this short sale. Anywhere from 2 weeks to 8 months for them to approve the short sales. So it can be a pretty frustrating experience. So you've looked and looked, you found the perfect house, now it's time to write the contract. So let's talk about the sales contract. So no matter who you are working with, the agreement or the paperwork is called the contract. Your real estate agent is going to know how to protect your rights so that you have the time to investigate the property. Contracts need to be in writing to be enforceable in the state of Virginia. That's why we don't make verbal offers back and forth on real estate. You want to ask questions and know what you're signing, and you want to understand the estimate of funds that you need for your down payment and closing costs before you write the contract. So once we find a property, in addition to determining fair market value before you make your offer, we're also going to have the lender run an estimate of closing costs for you on that particular property before you make your offer. So what are the parts of an offer? So we have your contract date, your name, the name of the sellers, the real estate brokers and who they represent, the legal property description goes in the contract, the sales price, the down payment, the loan amount and the type of financing, the earnest money deposit, the settlement date, the settlement company who's going to conduct the settlement, what items stay with the property, in our area, most appliances convey, usually the ones that are negotiable are the washer and the dryer. Then there is the HOA or the condominium disclosure packet contingency that's in the contract. In Virginia, if there is a homeowners association or a condominium association, the owner must order the documents. It's a document package from the association. Those documents must contain the rules of the association, whether the current owner is up to date on their fees, what the fees are that are due for that unit, and if there are any pending liens and lawsuits against the association, you would need to know that, since if you buy there, you become part of the association, and then whether or not the owner is in violation of any of the rules or regulations from the association. Let's say they painted their door hunter green when they repainted it, and it was only allowed to be burgundy. The seller in the contract says that if they're in violation of any of those rules or regulations, they'll fix those for you before settlement. So that packet is your notice of those violations. Once you receive that packet, the contract creates a 3-day contingency for you to void the contract if you decide that you can't live with something in the packet. And you don't even have to say what it is. You can just give notice to void the contract. Then we have the appraisal contingency. If the property doesn't appraise for the price in the contract, you can ask the seller to reduce the price, put more money down, or cancel the contract. Termite inspection, or wood-destroying insect inspection, is what it really is. Either you or the seller pay for the inspection. If you pay for the inspection, you get to choose who does it. It's usually about $45. It has to be, even if the seller chooses the company, it has to be by a licensed wood-destroying insect company in the area. And if any wood-destroying insects are found, the seller in the contract is agreeing to exterminate, to pay for the extermination, and to pay for any structural damage that they found during the inspection. Then we have your home inspection contingency, your radon inspection, if you want to do a radon, any other inspections that you want to do. And we're going to talk about inspections in a moment. Then we have your finance and your appraisal contingencies. The contract is always contingent on your financing. You have to go forward. You have to do things in a timely manner. And you don't want to do anything to be in default, like quit your job, go buy a new car that makes you not qualify, stuff like that. And then if the seller is going to contribute any money towards your closing cost, that goes in the contract. So once we write the contract is then taken and we present it to the seller's agent, and they have 3 choices. They can either accept it, reject it, or counter with something else. If they counter back with something else, then you can either accept it, reject it, or counter back with something else. And we go back and forth like that until we have a meeting of the minds. And during that time period, another contract can come in, and until the seller signs off and the buyer signs off on everything, it's fair game. So you want that negotiation to happen fairly quickly back and forth between you and the seller. So once we have a meeting of the minds, everybody signs off on everything, we have a ratified contract. And then the time frames in the contract are going to start. So let's start talking about some of that. Parties involved in your transaction. Wow. Somebody once told me there are probably about 40 different parties in a real estate transaction. A lot of them are behind the scenes and you never know about them. Our job as your agent is to coordinate all the parties on your behalf to help you get to the settlement table. And, in our industry, nobody ever seems to do their job. So one of our big jobs is making sure that everybody else is doing their job in the transaction. So we wear a lot of hats. So your contract's ratified. Now we're going to go to step 5. You're going to contact your lender that you got your pre-approval done with and finalize your loan. Now, you got pre-approved, but you may not have shopped around to see if the lender you're pre-approved with has the best rate. That's the time for you to do that. Now that you know exactly what you need time-wise, the type of loan that you're going to get, you can shop around, make sure the person you're pre-approved with has the best rate. If they don't, maybe they'll match what you find out there. Discuss with your lender whether it is a good time to lock in your loan rate. We're going to send them a copy of the ratified contract, and they're going to order the appraisal on the home and finish the processing of your loan. So step number 6 is your contingencies and your inspections. So the most common inspection is a home inspection. And the contract, we make it contingent, say, on 7 days from the ratification on you hiring a professional home inspector to go out and inspect the property. If any problems are found at the inspection, and the inspection is going to take a couple hours, You're going to be there. We're going to be there with you. The seller usually gives us some privacy, and of course the home inspector is going to be there. After the inspection, if any problems are found, they're going to give you a report about the inspection. It's also, even if they find no problems, it's a great education about your new home that you're going to have from the home inspector. If any problems are found, we're going to put together an addendum, and we're going to go back to the seller and ask them for what we want them to fix. Or sometimes it's a renegotiation of the price. Sometimes there's a credit given to you in lieu of repairs. And we negotiate back and forth like that with the seller until we come to an agreement. If we can't, then you can get out of the contract without any penalties, and you get your earnest money deposit back, which, by the way, we forgot to talk about that. Your earnest money deposit is money up front to hold the property until you get your financing and get to settlement. The seller's promise is to take the property off the market and not sell it to anybody in front of your contract. They can always take a backup offer, but they can't put anybody in front of you. Your promise is that you're going to go forward and pursue your financing diligently. At settlement, you get your earnest money deposit credited to you. And an earnest money deposit on this $400,000 townhouse would be about 1% or $4,000. It gets held by the real estate company, and then it goes towards your down payment and closing costs at settlement. So you want to read any disclosures from the seller, schedule the home inspection within 7 days, negotiate any repairs. Other inspections might include the termite, which is a contingency in the contract. We talked about that. If you want to do a radon inspection, that would be another contingency. Home inspections, radon inspections, lead-based paint test, you pay for those at the time of the inspections. Your lender is going to order the appraisal through a third-party company. And within 7 days of the ratification of the contract, you also want to call around and get quotes for your homeowner's insurance for your new home. So most other types of inspections might be things that might come up at the home inspection that might need further investigation. Like maybe they find something structurally and you want to have an engineer come out and look at it. They red flag the roof and we need a roof inspection, electrical inspection, stuff like that. So the waiting period. So the waiting period is usually the time between your inspections and the time between your walkthrough and your final settlement of the property. And typically, like I said, contract to settlement is usually 30 to 60 days. So what are you going to do during that period? Well, you can start packing up the things that you don't use every day. It could be a good time to do some decluttering, donating gently used items. Your lender will need any remaining documents required by them and by their underwriter. What they do is they take your package and they put it together as nice and neat as they can, and they present it to the final underwriter who gets the final decision at the lending company. And often that underwriter will come back with some conditions, and it will be last minute, so don't be upset. It's usually when you've packed everything away and they're going to ask for one more thing or two more things. So they're not picking on you. They just want to make sure that they're crossing all their I's and dotting the I's and crossing the T's. So then the lender is going to give final loan approval after the appraisal is complete and the loan's cleared the underwriting department. 2 days before closing, you're going to receive a final closing statement so you can review all your final cost. So there won't be any surprises at settlement. If you've already gotten your closing cost estimate in the beginning, then you're going to get the final one 2 days prior to closing. So step number 7 is the walkthrough and the settlement on the home. So you want to call the utility companies, transfer the utilities into your name for the day of settlement. Just prior to settlement, we're going to go to the home and we're going to do a final walkthrough inspection of the property. And you want to ensure at that inspection that any agreed upon repairs have been completed and that the home is in substantially the same condition as when you wrote the offer. It takes about 45 minutes and we'll go there with you and go through the property. You're really making sure it's in substantially the same condition, that we get receipts for repairs from the home inspection, stuff like that. And don't worry, if we go and the dishwasher's on the blink, it's not going to stop our settlement. We're just going to keep some money set aside from the seller's funds to make sure the repair can get done. Finally, the day that we've all been waiting for, it is settlement day. So what's going to happen on settlement day? Who attends settlement? Well, the buyers, the sellers, the real estate agents, and the settlement officer or attorney. Usually it's at the same place. Sometimes the sellers will sign at a separate company. It is the date specified in the sales contract, usually 30 to 60 days from the contract. Or if it's a new home, it's going to be when the construction is complete. It's usually held at the settlement or title company's office, and sometimes it's held at the real estate agent's office. It takes about an hour to 2 hours as long as there's no problems. So the first thing we're going to do when we get to settlement is we are going to review the walkthrough and make sure that we resolved any issues that came up at the walkthrough. Then the seller is going to sign their papers to convey the property to you, and you're going to sign all your loan documents. Once all your loan documents are signed, then the keys are going to be exchanged and you get to do the fun part. You get to move. So what happens post-settlement? Let's talk about that for a second. The settlement company, after settlement, is going to go to the courthouse, and they're going to do a breakdown of the title one last time to ensure no new liens got recorded against the property since they did their initial title search. Then they're going to record the new deed and the loan note in the land records at the county courthouse. The settlement company is going to send the funds from the transactions to all the parties. They're going to pay off the old loan, notify the condo and the HOA associations that you are the new owner, and the signed loan documents are going to get returned to the lender, and you're going to receive a copy of the title insurance policy by mail and a copy of your new deed. So keep it in a safe place. Don't get rid of your title insurance policy even after you sell the property. So that's it. It's that easy. Easier said for me, right? So thank you guys for coming. We really want to say thank you by giving you guys a gift package for people that attend the webinar and work with us and our designated lenders to finance their new home. We put together this great gift package valued at over $1,000 for you. You get a $500 closing cost credit from the lender. They're going to give you a free mortgage approval. We're going to give you a free 1-hour consultation with our team to help you determine the best home buying strategy. Access to this webinar to watch over and over as many times as you need. We're also going to give you a free copy of our guide, Let's Find a House. My buyers that I've worked with tell me that they keep this with them at all times. They never go anywhere without it when they're in the home buying process. And then we're also going to give you a gift, a choice of gifts from our Appreciation Station game board valued at $300. So here's a picture of the board. We have all kinds of great things on here. We've got donations to charity. We've got Uber gifts, Target. Probably the most popular ones are going to be Lowe's and Home Depot. I don't know why. So what's my next step? Well, you want to call or email me to set up your free 1-hour homebuyer consultation with our team and me. We'll put you in contact with our preferred lender to get you pre-qualified for a mortgage and get your loan pre-approval started. And then you want to enjoy the house hunting process now that you've been educated and you have knowledge, the knowledge that you need to take the next steps. And then if you guys wouldn't mind, please tell all your friends about the Tammy Irby team and this great webinar. We'd really appreciate it. So give us a call, 703-929-3540, or email me, Tammy at livetheeasylife.com, or you can visit our website at www.livetheeasylife.com. Thanks for spending some time with us, and we hope to help you find your next home. Bye-bye.